Hey, good afternoon. My name is Tom Goekeler. I'm a Chief Practice Officer with Eide Bailey in our Tulsa office, and I'd like to welcome you to our second webinar on the CARES Act and specifically the SBA provisions of the Act. Our first webinar was on Friday, April the 3rd, some 2 short weeks ago, and the first day of application for the PPP program. And in those 2 short weeks, the funds have been exhausted. Hopefully today or early this week, we'll learn that the government's going to replenish that fund and put some more money in to give more businesses access to this much needed relief. Just like the first webinar, we've seen unprecedented interest in this topic, and we're happy to walk you through the next steps of the loan program. Presenting with me today are Adam Sweet, a principal of the firm from our Spokane, Washington office, and Michael Holdren, the senior manager of the firm from our Des Moines, Iowa office. So today's agenda, we're going to walk through lessons we've learned since the last webinar 2 weeks ago. What is new? There were some guidance issued between April the 3rd and today. What you do now that your loan is funded, if you have had a loan funded, and preparing for the forgiveness phase of this program. So I'll turn it over to Adam and we'll get started.
Thank you, Tom. And I see, just like a couple of weeks ago, we have questions rolling in both via the Q&A and the chat. You know, if they're common questions, we'll try to get to them as we go, but we were overwhelmed last time with questions, and I suspect that may happen again today. So when the webinar is done, we'll try to collate these questions to the best of our ability and get back to people. And what I just say as well, and this will be a common refrain, is don't be shy about reaching out to your local Eide Bailey professional, whoever that is, because we have kind of designated leaders in each office that are tracking this program along with us. So if we're not able to answer your question, reach out to your local Eide Bailey professional, whoever that is, and they can track down the answer for you. So just by way of background, we covered this 2 weeks ago. We'll cover this a lot quicker today, but the Paycheck Protection Program, or PPP, was introduced as part of the CARES Act. CARES Act was passed maybe a month ago, a little over a month ago. The PPP specifically was a $349 billion program that was part of that temporary program. The initial appropriation of $349 billion was exhausted as of April 16th. So as Tom mentioned, April 3rd, the floodgates opened. 13 days later, the floodgates closed. We're hoping they're going to reauthorize the program. They're going to refund the program. It sounds like the people up in DC on Capitol Hill and in the White House, sounds like they're very close to a deal, and hopefully we'll see new funding of that deal. It's administered through the SBA's existing loan program, but importantly, almost all the interaction a borrower is going to have is through their local lender. So they're not going to have to interact directly with the SBA through your local lender, even though it's an SBA program. It's been very fast moving. You know, we had the statute a month ago. When we did our webinar 2 weeks ago on April 3rd, April 2nd at about 7 p.m., the Treasury had dropped 30 pages of regulations on us. Since then, we've had another batch of regulations that came out last week dealing with self-employed individuals. And then on top of that, there's a rolling frequently asked questions page that the Treasury updates every few days. And I'd encourage everyone, if nothing else, that's something to check, because it's fairly approachable. They approach the questions from the standpoint of what questions are people asking them, and I think their answers, as much as they can be, are readable. It's not just for us, it's for anyone out there. And then finally, the way I think about this, the way I explain this to people, there's really 2 stages to this loan program. There's the loan stage, which is getting approval, the 2.5 times your payroll, getting funded. And then there's the forgiveness stage, and that's what we're going to focus a lot of our time on today, is the second stage. You have your money, now what? Lessons learned, we'll go through this pretty quickly here. In the FAQs that I mentioned from the Treasury Department, there was an interesting tidbit that came out last Monday. As you know, as most people know, for the PPP program, these first 2 categories of businesses people are already familiar with. It's generally speaking 500 or fewer employees. You're eligible. There's rules of affiliation that can group commonly controlled businesses together for purposes of that test. There's special rules for franchises and special rules for businesses in the hospitality industry. The NICS code beginning with 72, so restaurants and hotels. You know, that's been in the news a little bit about maybe large chains that receive funding. You can quibble with whether that should happen or not, but that was pretty clearly Congress's intent anyways. Also, if you meet the small business concern definition, which is a particular definition in the SBA regulations, generally it ties or it goes based upon number of employees and revenue. Good question. I just saw, what is the website for FAQs? It is just Google Paycheck Protection Loan frequently asked questions, and I would guess it's one of the first things that pop up. Just make sure that it's coming from the Treasury or from a .gov source. And we can send that, we'll send that link afterwards. That's a good question. The third category surprised us, and maybe it was just our ignorance. I mean, I think actually really the statute wasn't clear on this point, but the third category of people that may be eligible are if you meet what's called the alternative size standard. I mean, this is big because you can have more than 500 employees, and if you meet this alternative size standard, you can potentially qualify for a PPP loan. And this alternative size standard looks to both tangible net worth, and then it also looks to average net income. And we have both those numbers there. Tangible net worth of 15 million, average net income after taxes of 5 million. If you meet that size standard, you can apply for a PPP loan. So we've had several large clients that have more than 500 employees that are looking now at this specific thing. And once Congress re-ups this program and funds the program later this week, they're going to be applying. Maximum tangible net worth is not really a defined term other than clearly you don't include intangible value. So, but otherwise, whether you're looking to GAAP numbers or tax numbers, we're not exactly clear. So that may be something, if you're looking there, something your lender asks about. There is no answer. People suggest GAAP, people suggest tax. It's probably whatever your lender will accept. Another lesson learned, as part of the CARES Act, separately from the PPP program, as part of the CARES Act, the government allows an employer, no matter who you are, large or small, you can defer the employer share payroll taxes for 2020 and you pay back in 2021 and 2022. It's basically an interest-free loan. If you read the payroll tax deferral statutory language, it seems to state that you can't receive the payroll tax deferral. You can't claim the payroll tax deferral and claim PP loan forgiveness. Turns out that is not necessarily a correct reading of the statute, or maybe the IRS got creative and the IRS came out with an FAQ last week stating that you actually can claim the PP loan and claim payroll tax deferral up to a point. Maybe Michael, if you want to walk people through how that might work.
Sure. So this is something definitely that caught our attention and is a benefit to those who have used the PPP loan program. And an example would be, let's just say that a loan disbursement. So you received your funds on Friday, May 1st. That's the date your 8 weeks begins. Your 8-week period then would end on June 26th. And let's assume that you have all of your documentation ready to go and you apply for forgiveness immediately on June 26th. The statute allows the lender up to 60 days once that forgiveness application is submitted to render a decision on the forgiveness application. And once that decision is made, and assuming that the employer or borrower in this case is approved, that would be your trigger point that you would no longer be eligible to defer the deposit and payments on Social Security tax due. One interesting piece that was included in the statute, however, is a lender can request advance forgiveness from the SBA, and that is available after 7 weeks. So prior to the end of that 8-week period. What's not clear is what documentation the lender has to submit to the SBA to get advance forgiveness. And what's also not clear is if that would be a trigger point for the borrower or employer to stop being able to defer those payroll taxes. So as you approach the end of your 8-week period, or as we see more guidance come out from the Treasury and SBA, something to keep in mind, but we all agree that this was certainly a welcome surprise from an FAQ standpoint from the IRS.
Yeah, and really think of it, the payroll tax deferral is an interest-free loan. So you will have to pay it back just in 2021 and 2022. So it's a cash flow. If you need the cash flow this year, you can make use of the program. You don't have to. If you don't need the immediate cash and you don't want to have to be responsible for paying it back, then you don't have to do it.
Well, I think what Adam was alluding to in terms of that cash flow piece, that is important for a lot of our small businesses, given the fact that many are hopefully going to get back into business, and right now they are in a cash crunch. So that's why we think that this is that payroll tax deferral might be something that you certainly want to take advantage of during this period.
Yeah, absolutely. And sorry, that was my fault. I clicked on the wrong button there, audience. Another lesson learned, EIDL loans, which are also SBA loans, separate program from the PPP. It was advertised as a way to get immediate cash. So PPP loans take some time, as people know. The EIDL loans advertised it that you could apply for an EIDL loan, receive a $10,000 advance, supposedly within 3 days of application. And it was unclear how the EIDL program worked alongside the PPP program. Well, we had some clarity on that you can apply for both, and the limitation is that you can't use the proceeds for the same expenses, that they need to be used for separate expenses. So if you're using PPP for payroll, you'd have to be using the EIDL for others. We had a lot of clients that maybe weren't eligible for PPP loans because they didn't have employees. You know, the example we saw a lot of is if you own property, if you're a landlord, and tenant has told you that they're not going to pay rent, a commercial or a residential tenant, saying, hey, I'm skipping rent for a month or two, the PPP program won't provide any relief because you don't have any employees or payroll expense. So one thing we suggested to landlords was, hey, look at this EIDL program. What's interesting is our clients that applied who don't have employees were turned down for the EIDL loan. And the snippet below is the email that was sent out to people from the SBA. And for whatever reason, the SBA decided that EIDL loans, like PPP loans, are only going to people with payroll. And the advanced $10,000 credit is only paid based on the number of employees you have, $1,000 per employee up to $10,000. So in the example I gave of the landlord whose tenant has said they're not going to pay rent, the answer back from the SBA is no EIDL $10,000 for right now. Surprising because there's nothing in the statute that says that's the result. Nothing in the EIDL program says you need to have employees. Nothing in the EIDL program says that the $10,000 grant is based on the number of employees. But pretty clearly, the SBA behind the scenes has made a policy decision that they're pumping all of this money towards people that are maintaining payroll. The payroll expenses, we debated this. I thought I knew the answer before, but there's been clarity from the Treasury that most people have read about that there's a $100,000 cap for wages paid, and that matters both for 2.5 times when you're computing your loan amount and also the forgiveness amount. Both of those calculations have a definition of payroll. The statute tells us that anything over $100,000 doesn't count. The question was, there's other buckets of payroll expenses that can count. So you have, for instance, there's salary, there's retirement, there's sick, there's other benefits that go into play or that go into the definition of payroll. What the Treasury told us was the $100,000 cap only applies to salary and does not apply to the other buckets. So the retirement, the health, the other buckets. So in my very simple example here, if you have an employee with $150,000 of wages and you also pay them $30,000 of retirement and health benefits, their number would be, their salary is capped at 100, so you knock the 150,000 down to 100, but you can include the 30,000 of retirement and health. So their net payroll number would be 130,000, and that would be both for the 2.5 times number up front to compute the amount of loan you're eligible for, and that will also be the amount that goes into play for forgiveness on the back end. Also, this is the point that I think Tom, Michael, and myself all agreed with, even just reading the statute, but there was a lot of debate. The wage number, the salary number is gross, so you don't reduce federal withholding or FICA taxes don't reduce the wage. They don't get added on top of the wage, but if you pay someone $50,000 of gross salary, and then there's federal withholding and FICA taxes, that's not netted against the $50,000. Makes sense because the $50,000 is the outlay from the employer. So if that's the cost, that should be the number that goes into the 2.5 times payroll. There were banks, I think, that were confused on this point, and so there may be people out there that didn't receive their maximum loan because of this. Also, payments to independent contractors are not payroll of the payor company. And instead, we're going to get into this in a second, but they're considered payroll. And when I say payroll, I put it in quotes, payroll of the recipient independent contractor. So there shouldn't be any 1099 payments in a payor company's payroll calculation. Brings us to our first polling question. Gross wages are reduced by the amount of federal withholding and FICA for purposes of the PPP loan calculation. FICA is your employment taxes. True or false?
All right, we're going to leave this open while Adam carries on with the presentation.
So this is maybe the most substantive or material update, and we mentioned this in passing because on our last webinar, this was dropped on that. Our webinar was Friday morning on Thursday nights, or April 2nd. This was dropped in our laps, and we noticed it in passing. We didn't really have time to process it much more, and I call it the 75% rules. The first, it's confusing in a way because the regulations that were released first talk about forgiveness, and they say that if you're pursuing forgiveness, and we're going to go into more detail on this as we go along, but if you're pursuing forgiveness, the non-payroll portion of the forgivable loan amount, the non-payroll portion of the expenses that give rise to the forgivable loan, is limited to 25%. I don't know why they said it that way, because I think another way to read it is just that 75% of the loan proceeds have to go towards payroll for forgiveness purposes. But they read it the first, they explained it the first way based on the 25%. Noteworthy because that is nowhere in the statute. The statute doesn't say that 75% of your proceeds have to go to payroll. The statute just, I think there's 4 or 5 buckets of expenses. It says make sure you incur A, B, C, D bucket, and as long as you do, then you can have a forgivable loan. But SBA, in their infinite wisdom, tells us, and that's the quote below, that basically 75% is an appropriate percentage because the act being the CARES Act, its focus is on keeping workers paid in payroll. Now, the second portion is the one that has been harder to process, and there's been a lot of confusion out there. Buried a couple, maybe 10, 15 pages after this first section, the second part says, it appears to say, even forgetting forgiveness for a second, 75% of the PPP loan proceeds shall be used for payroll, full stop. So even if you're not worried about forgiveness, even if you received a loan and you're just like, you know, I'm not gonna worry about forgiveness, I need cash flow for the next 2 years, I have a 1% loan, and I'm gonna use it to pay rent, I'm gonna use it to pay overhead, the SBA seems to be saying you can only do that if 75% of the proceeds go to payroll. There's been a lot of confusion because it was introduced after the forgiveness section. And so some people are trying to force read this second clause as somehow only relating to the forgiveness section. I think if you can look at the quote I included below, it's pretty clear what the SBA is saying. Now, we may look foolish here. If they come back in a week and the SBA says, oh, we misspoke, it's only forgiveness, well, that's for the better for everyone. But to me, when I read that language, I don't see any confusion there. I mean, you can quibble with whether the SBA should have come up with the rule, but I think it's pretty clear they have the rule. It's, when I say confusing, you'll read articles on the internet from other firms, commentary, where they won't hit the second point. And I'm not sure how you avoid that, given how clear the SBA was. What we don't know, and this is the kicker here, is part of the interim rules that were released. There was a series of certifications that you need to make when you apply for forgiveness. And one of these certifications says this, that I understand that the funds are knowingly used for unauthorized purposes. The federal government may hold me legally liable for such charges of fraud. And this is in bold, as explained above, not more than 25% of loan proceeds may be used for non-payroll costs. So it seems to say somehow if you knowingly spent more than 25% of your loan on non-payroll costs, potentially it's fraudulent. Fraudulent matters because these loans are non-recourse loans, no guarantees, meaning the government can't go after you personally, but if you committed fraud in the application process, then the government could. So I don't think it's an accident the government put that in there, but we're still trying to parse through what that means. And maybe Michael, you can kind of help us think about what this means from a practical standpoint.
Yeah, I think along these lines, it just stresses the importance of tracking and supporting the expenses of your PPP loan proceeds. Similar to the application process, there is a certification process for the loan forgiveness application as well. And the statute reads that the documentation presented is true and correct. And that has to be provided to your lender for their approval and then submission subsequently to the SBA. But we do think that that's important. And the reason why that could be even more important now is there was such a rush to get the funds out on the front end that there could have been some leniency or guidance was being kind of released along the way through that initial funding period. This forgiveness period starts at that 8 weeks after disbursement, and by the end of those 8 weeks, we're going to have guidelines on how this process is going to work. Probably pretty, hopefully, understandable rules. So that certification, I think, is even more important. You're going to know these rules and have to certify that what you're submitting is true and correct. But along that line, we do kind of think there's a reasonable expectation to potentially have a separate bank account for these funds. If nothing else, it just helps track those funds over the 8-week forgivable period to really ensure that you are hitting that 75% threshold for not only the forgivable expenses, but as Adam mentioned, the loan proceeds, which kind of was a surprise to us initially on that April 2nd release. And then one of the big elephants in the room right now is for those that have had their loans funded and they're starting to incur expenses, is the statute discusses the forgivable expenses as costs incurred and payments made. And there's a lot of ambiguity there and a lot of questions surrounding what that language means. And we'll get into a little bit more detail on that.
And I saw a couple of questions. Yeah, the 75%, the SBA is telling us that's not just for forgiveness, it's also the PPP loan itself. So it is perplexing, but literally that's what the language says. And I don't know how to, without the SBA backing away from that rule, I don't know how to have a separate interpretation from that. So what are the implications? I saw some questions too. The definition of payroll is salary to 100 grand, health benefits, retirement, sick leave. What else am I missing, Michael? Anything? I know we're trying to go to PPP 201 today rather than 101. So we skipped those definitions, but all the things that you would normally incur in terms of maintaining a workforce, I think, mostly go into that payroll.
I believe that is in the FAQ that you mentioned earlier, the definition of payroll costs. So another good reason to check that out.
So what happens if you meet, this is really the question of the day, what if you don't meet the 75% rule? And when I should say 75% rules, and the reason why I say that is both the forgiveness 75% rule as well as just the overall use of the proceeds, what happens? And I think at a minimum, this is best case scenario in my opinion, it's going to reduce the amount you can get forgiven. And you can follow my math here. I'm an attorney. I'm not a CPA. So if I get the numbers wrong, then you know why. But if you start with a loan of $1 million and you only spend $700,000 on payroll, which is 70%, then by my math, only $133,000 of the loan could go to eligible non-payroll expenses. And what that would leave is $66,000 of loan proceeds that are not forgivable. And what do? Is that money returned to the lender? You know, what happens if you've spent that money on something else? What if you spent it on rent? What if you spent it on utilities and so forth? What are the consequences? We don't know. And I think when I said that, I think this is a favorable interpretation because there have been other people that have suggested failure to meet the 75% rule could jeopardize all forgiveness. It could be a cliff effect, meaning if you spend 74% on payroll rather than 75, you get 0 forgiveness. And then also, what about if the loan itself, 75% of the loan itself is must be used towards payroll, then what happens if you don't meet that standard? What happens if you only do 70%? If you have an invalid loan? These are things we don't know. The SBA has not given us an answer to. You know, hopefully we'll get an answer. And frankly, hopefully they'll back away from some of this. We're not trying to scare anyone, but we've spent the last 2 weeks beating our heads against that language. And to us, it's pretty clear what it says. Less clear is what happens from it, but you can imagine the uncertainty from it. Michael, you give us a quick overview of the Main Street lending
Sure.
program.
So on April 9th, the Fed Reserve also introduced a new lending program called the Main Street New Loan Facility. And this program provides funding to small and medium-sized businesses, but important is these loans are not forgivable. Similar to your PPP loans, this loan facility is accessible through the bank. The program provides expanded relief as it provides up to 10,000 employees in terms of eligibility, or less than $2.5 billion in annualized 2019 revenue. So pretty significant increase in the eligibility of businesses under this program. They are probably for what I would say larger businesses, because the minimum loan amount is $1 million with a maximum of $25 million. The terms of the loan are, they're a 4-year note. The first 12 months of principal and interest are deferred. Carries an adjustable rate of 2.5% to 4% over the secured overnight financing rate, which right now is 0.01. So essentially the terms of the note are 4 years with a rate as of today about 2.5% to 4%. So increased cash funding for probably what would be considered more medium-sized businesses in this case, maybe some that were excluded from the PPP loan program. And this was just introduced by the Fed Reserve on April 9th.
And not forgivable. That's it's real debt.
And there's a number of other kind of what would be certifications that go along with this, that it can't be used to refinance other debt and a number of things, but that's beyond the scope of today's webinar.
When we had our last webinar, the other big open question we didn't know is, how do you get a PPP loan if you're self-employed? We knew how it works. If you're a business with W-2 employees, you pay a wage. We know how that worked. We didn't know how it worked for self-employed people. The reason why we didn't know is you don't pay yourself a wage if you're self-employed. If you have a single member LLC and you have your Amazon selling business or whatever you do, you don't pay yourself a wage. You just have income, you net your expenses out, and then that's your income for the year. So we had new guidance come out last Monday for self-employed people. The other question that came up a lot too was, what about a partnership, partners in a partnership? Partners generally are included, self-employed are determined to be self-employed individuals. So I'm a partner at Eide Bailey. Even though I may think of myself as an employee of Eide Bailey, for tax purposes, I'm actually considered self-employed. So for partners, what the rules that came out last week told us are partner compensation, which could be your line one income, or I think it even includes your guaranteed payment, is payroll of the partnership, as long as it's self-employment income, which would be income from services. And the way they define this is in the rules. They say self-employment income of general active partners. That's not it's a term of art, not a defined term, but I think generally speaking, it just means anyone who's performing services in a material fashion for a partnership and is receiving self-employment income. Their income can count as wages for the partnership when the partnership applies for a PPP loan, not the partner, the partnership, up to the $100,000 limit that we're all familiar with. Unclear right now how you demonstrate you incur that cost, because this is only the first part. This is the 2.5 times loan. When it comes time for forgiveness, unclear how you show that you've incurred that cost during the 8-week period. Hopefully we'll have more guidance on that as well. But this is maybe a rule of simplicity that what the SBA said was it would be too difficult to have each partner apply on their own, so we're going to have the partnership do it. For pure self-employed people, so not partners, but pure self-employed people, what the Treasury Department and the SBA came up with was a concept called owner compensation replacement, and they use it as a surrogate for payroll. And what you do is you pull up your 2019 tax return if you've already filed it. If you haven't filed it, create a draft, and you pull up the Schedule C. The Schedule C is where self-employed people report their income and their expenses. You take the net profit item from that Schedule C, you divide that by 12 to get a monthly average, and then you multiply that by 2.5. That's your payroll, and that's your PPP loan. Now note there, if you had a loss in 19, you don't receive a PPP loan because you had no net income. So if you took a bunch of bonus depreciation or 179 depreciation, then you have no net income and you have no loan. When it comes time for forgiveness, which is the 8-week period when your loan is funded, you again, you annualize it and you do 8 divided by 52, which is that 8-week period divided by 52 weeks total, again multiplied by a 2019 net profit. This is the rule of convenience because otherwise it would be too difficult. There's no way to show what a true compensation of a Schedule C person would be during that 8-week period. So really they're giving you, if you do the math on that, they're giving you an automatic forgiveness of that amount. The 8 divided by 52 times 2019 net profit is basically automatic forgiveness on that. So pretty generous if you're a self-employed person, if you're a Schedule C person. Also, though, they keep reminding us that and this is why we always draw pause to this, but they remind us again, they being the SBA, that the 75% rule also applies to self-employed individuals. Question there is owner compensation replacement part of that definition of payroll? If you look in the rules, payroll is a separate bucket from this owner compensation replacement. So it could be a lot more restrictive for self-employed people because they don't typically have payroll other than what they draw themselves. Whereas if the owner compensation replacement is considered payroll, then that would be more generous and that would give more leeway to use other portions of the loan for other expenses. So we don't know at this point what that answer is. Maybe just a, yeah, Michael, just a quick example. Yeah.
So if we take a look at, an example of the information that Adam just described to us, you take like he mentioned, your 2019, your Schedule C net profit in this case was 48,000. You go through the calculation to determine your loan amount. And in this case, we get a $10,000 loan. So your 75% threshold would be 7,500. Your other forgivable expenses would be the 2,500. But note under the forgiveness piece, based on the calculation from the self-employed guidance, the 8 out of 52 weeks, you take that times your Schedule C net profit, that your automatic forgiveness that Adam mentioned is $7,385. What's interesting is there's a difference there between that and the 75% of the 10,000 or 7,500. So in essence, it's kind of creating a small unforgivable or residual loan balance based on the differences in the calculation of the underlying loan amount that was dispersed versus the forgiveness under the self-employed guidelines that were recently released.
This was current as of April 13th, so a week ago. I thought this was just an interesting breakdown. I think there's been a lot of back and forth in the news about the PPP loan program. How effective was it? Was it favoring large businesses over small businesses? And I think what this shows is really, for the most part, most of the loans were probably going to what you might consider small and medium-sized businesses. This shows the net loans at $1.6 million of loans, 342 or 1.6 million loans, $342 billion of net approved dollar, and then almost 5,000 lenders that were approving. And you can see here that the majority of the loans were for under $150,000. Now there are loans above 5 million or above 5 million as well at the very bottom of it, but really a huge percentage of the loans were going to people with payroll 2.5 times payroll of between $150,000 and $350,000. So I think the data shows, again, you can argue about the PPP loan program that it's too complicated and this and that, but this shows probably that the majority of the proceeds were going to small and medium-sized businesses and weren't going to businesses that were taking $8–10 million loans at a time. So as Tom mentioned in the beginning, the initial $349 billion appropriation was exhausted as of April 16, 2020. So 13 days, it's gone. Lending is temporarily suspended. If you go to a lender right now, they're going to say no. If you go to the SBA website, it says suspended. I had this highlighted as a reminder for myself. Hopefully we'd have an update by Monday to share with you guys. There is no update now. I think they're about 95% of the way there to they being Congress, the Senate, and the House, and the White House, but 95% of the way there, or maybe even 99% of the way there to agreeing to fund this. And last I heard, and we were talking to Michael and Tom this morning, I think Wednesday may be the day that they pass it and that the floodgates open back up again. So if you were denied an application because you just got in too late, I would still be knocking down the door of your lender, having everything ready to go, because it may be Wednesday or Thursday suddenly that we have a new rush of money come in. And if it's anything like the last time, it may only be there for a week or two. And I'm not sure that Congress will come up with a third appropriation at this point for it. What percentage of eligible expenses are required to be used as payroll costs? 75, 50, 100, or 0? So this brings us to our next portion of the presentation. We kind of through what's new, and for a lot of our clients, they received funding last week. So very uncertain application process, lots of back and forth, but suddenly cash shows up in your account, or at least shows up in the loan account at the bank. And what are the next steps? And I think the point we want to emphasize here to people is now is the time to plan. And this is going to be a reoccurring theme over these next 20 minutes. But now's the time to plan. If you wait too long, you're going to lose out on some of the forgiveness. And the reason why is that 8-week clock for tracking forgivable expenses begins upon the date of disbursement of the loan proceeds. Even if you only take a partial draw, so if you leave 80% of it in the account and only take 20% of it, that 8-week period begins. And if you want your lender to wait to disperse the funds, they don't have that much leeway to doing it. They have 10 calendar days from the date of loan approval to fund your loan. So immediately right away, the clock starts ticking. And what are we worried about, or what are we thinking about here during this 8-week period? Well, remember, the first part of this process is getting your loan. Second part is the forgiveness. And your forgiveness amount equals the sum of the following costs incurred and payments made during the covered period. And the covered period is that 8-week period beginning on the loan funding date. And here are the things: payroll costs, interest on a covered mortgage obligation, payment on a covered rent obligation, covered utility payment. Now again, it's misleading because really payroll costs should be taking up 75% of that slide, and everything else should be taking up 25%, because even though the statute treats these categories all as equitable, SBA has told us no, 75% of it has to go to payroll. So it brings, if you look there, the bolded, the incurred and payments made during that 8-week period, it's curious language, because is that an accrual concept? Is that a cash concept? You know, paid would sure seem to be a cash concept. Incurred would sure just, you would think an accrual concept. So what are we measuring here during the 8 weeks? Is it just pure cash outlay? Or is it somehow an annualized accounting of expenses? Are you trying to accrue over 52 weeks and then carve out the 8-week percentage of that? You know, and along with this, we get this question from a lot of clients: what about prepayments? What if you want to prepay payroll? What if you want to prepay rent? What if you want to make advanced payments? What if you have an employee and you want to pay them 3 months of payroll during that 8-week period? Does that work? What about overtime? Does that work? I think Michael here has an example, maybe to kind of walk through, simple example, but walk through some of this uncertainty.
Yeah, and as Adam mentioned, I don't know that we have a clear answer on this, but this example kind of provides maybe a little bit more of a way to look at this. So if you had a loan disbursement as of April 15th, your 8-week period for forgivable expenses would end on June 10th. So let's say that we had rent due April 1st, and we're paying monthly rent for the 30 days in April. We pay that on April 1st when it's due, but the costs incurred are from the 15th through the 30th. However, our payment was made outside of that 8-week window. Does that costs incurred for the period that we had the loan, do those count towards forgivable expenses, or is this excluded because that payment made was outside of that 8-week window? Again, not sure based on the guidance at this point. The same thing would happen then on the back end of your 8 weeks. You pay your rent on June 1st. that payment falls within the 8-week window. However, you only incurred costs through June 10th. So the 11th through the 30th, or 20 days of that payment, would not have been incurred during that 8-week period. And these cases are and issues are gonna run parallel with payroll, utilities, and interest, unless the timing of your 8 weeks matches perfectly with each of those different categories, which we obviously know it won't. We're going to need better guidance on how to account for these expenses during that 8-week window in order to submit our application for forgiveness to our lenders.
Yeah, we just don't know. I see the questions in the chat box. Which is it? We just don't know. I mean, genuinely, we don't know which is which. I mean, you would think one guess may be who will be providing the guidance, the SBA or the Treasury. One guess might be that they might adopt more of an accrual concept, because focusing just on cash is going to benefit certain people. If your loan funds the day before your rent's due, then you're going to get a benefit, versus if your loan funds and your rent's not due for another month. But who knows? The SBA has been keeping us guessing with all of this. So genuinely, no one knows. So just again, I want to emphasize this, that's you can see some of the confusion there, but really the emphasis needs to be in planning and modeling on the front end of this. If you wait too long, if you wait till the end, then you may get penalized. And if you think about it, even if that previous slide, a couple slides ago, that the average loan was $200,000, let's say you make a mistake of 10% on the forgiveness side, so that you get 90% of the loan forgiven, but you miss 10% of it. That's $20,000. And you may find that that was an easy $20,000 to plan for on the front side if you got in front of this. So just can't emphasize it enough that you need to be thinking now, if you've borrowed money or you're going to borrow money, thinking right now, how am I going to spend this money? And let's make sure I spend it the right way and maximize it the right way to get full forgiveness. So
building on the thought that we had earlier, potentially using a separate account, while not required, might be advisable, especially to some of our smaller business clients and those of you that got these PPP loans, maybe a little bit less sophistication or time dedicated to your accounting. Potentially consider putting these PPP loan proceeds directly into a payroll account that you use to fund your payroll. In that case, you would certainly know that those funds are going to or towards that 75% of payroll costs. But using a separate account obviously is going to be beneficial for tracking. You could potentially pay your expenses from your operating account and then fund your operating account or replenish it with the PPP funds that are being held in a separate account. One thing I think is important and something you might want to give strong consideration to is somehow flagging maybe through your entries or your description with a PPP, or somehow to be able to go back during and after that 8-week period to be able to search your accounting system for those expenses that you flagged as PPP or forgivable or qualified expenses. The main point here is that we just think that separating those or segregating those funds could help reduce the errors or the unintended consequences of kind of blending those funds into an operating account and potentially spending them on unqualified expenses.
So what are some other things to be aware of, in addition to the 75%? One thing that can hurt your forgiveness is if you reduce your full-time equivalent, your FTE count. And we have my next slide will kind of go into more details on what FTE is, but there's a penalty section of the statute that says that even if you achieve the right numbers during the 8-week covered period, meaning that you've spent enough money to get maximum loan forgiveness, if you've reduced your FTE count as compared to certain prior COVID-19 periods, then that can proportionately reduce your forgiveness amount. We won't have to go into too many details, but those 3 sub-bullets are the prior prior comparison period. So you're comparing your 8-week covered period after loan funding to those other 3. The bottom one is for seasonal employers. The top 2 is a choice. You can use either that February to June 2019 or January to February 2020. So it may require a business to restore its FTE count by the beginning of a covered loan period. And, consider the impact on, we've heard this from employers, but unemployment insurance right now, unemployment benefits right now with the extra kicker from the federal government are not so bad. And so there may be, it may be a little delicate sometimes asking employees to come back to work. So the question, I saw the question pop up in the chat box, what is FTE? Well, FTE is traditional, we don't know for the PPP program, but traditional governmental guidance tells us 1 FTE equals 30 hours a week, and 2 part-time employees at 15 hours per week equals 1 FTE. For PPP specific, it doesn't appear to be employee specific. So for paycheck protection purposes, as long as your FTE count is back up during the covered period to the period it was before, it doesn't seem to matter if you've 100% replaced your employees with a whole brand new crop of employees. Not suggesting you do that, but it doesn't seem to matter. You're not trying to match, I'm Adam Sweet. You're not trying to make sure that you bring Adam Sweet back up to full hours just because he was working full hours before. It just FTE. It doesn't say any specific person. Also, you have, if you've reduced your FTE count, you have up until June 30th to bring your FTE count back in line with the previous period and not be penalized. But this is kind of a trap, because if you've waited until June 30th, that means that you haven't incurred enough payroll expenses during the covered period. And don't forget about that 75% rule, that if you haven't spent 75% of your forgivable loan proceeds on payroll, then potentially it jeopardizes some of your forgiveness and maybe even jeopardizes all of your forgiveness. Maybe.
So an example to illustrate Adam's point here is, let's for instance say that we have a small business that operating at limited capacity and because of that has reduced or furloughed half of its FTE count. They have the plans to bring them back by the end of the 8-week period, obviously before June 30th, in anticipation of their business capacity expanding and this period of uncertainty ending. But they may not be able to spend 75% of that loan on payroll. So the example would be our average payroll of $10,000, multiplier of 2.5, we had a $25,000 loan. At some point in time, we furloughed half of that workforce, so our payroll after the furlough is half of 10,000 or 5,000. So over the 8-week period, our payroll costs would be 10,000. For instance, we had $4,500 of other eligible expenses. So for our total 8-week forgivable costs, assuming they're all qualified expenses, we had total costs of $14,500. That 10,000 out of that 14,500 is just under 69%. So that's below that 75% threshold. And that's just on the forgivable piece of those expenses. That's clearly below the 25,000, 75% of the loan proceed portion here as well. So again, we don't know exactly what the ramifications of not meeting these are. The hope is potentially that $10,000 would be your 75% threshold, and you would be able to spend a pro rata portion on other eligible expenses. But that's a little bit unclear at this point. But it does illustrate the reason why we're kind of really beating this drum of planning ahead and trying to understand the impact of employee, the furlough or layoff decisions, and really trying to track those expenses throughout that 8-week period and not wait till the end and have a surprise on your hands. So
I saw the question come in. I don't think one person can give you any more than 1 FTE count. So if you have someone that's worked overtime 60 hours a week, I don't think you end up with 2 FTEs. We'll see what the SBA says, but that would seem probably a rule they may come up with. So as always, we're running short on time. So the other reduction just to be aware of is not only FTE count, but also reducing salary. And the focus here is if you reduce someone's salary by more than 25% during the covered period, that can work against you for forgiveness. A couple points, the focus is on specific employees here, whereas the FTE was an average count. This one is specific employees. So this is someone that was making X amount of dollars pre, and that same person is now making 25% less during the covered period. That can reduce your forgiveness. you have employees making more than $100,000, they appear to be totally excluded from this calculation. Kind of a quirk, I don't know why, but that's the way the statute reads. And then you can avoid the reduction by restoring any salary cuts during the covered period. Just a real quick example, if you have 3 employees, I'll cut to the chase, it would be only employee 2's salary is going to reduce your forgiveness. Employee 1's salary is only cut 20%. Employee 3's salary was cut 66%, but they were making more than 100 grand, so they don't work against you for forgiveness. Now, as always, as we keep saying, beware the 75% rule. If you're cutting pay, then it may make it difficult to, even if you're not being reduced on the forgiveness side, it may make it difficult to show that you've used 75% of the proceeds on payroll during the covered period. Open questions on the payroll, you'll note, we move quickly on this, but the comparison is for the salary comparison purposes, you're comparing what you paid someone during the 8-week period versus the prior quarter. That's very curious because a quarter, you know, if I do the math in my head, a quarter is 3 months versus 8 weeks is, you know, 2 months, maybe a little less than 2 months. And they use total salary. And that would seem to be impossible that you could pay someone in 8 weeks a total amount of salary that they made in the previous quarter. So our hope here is that the SBA is going to bail us out and give us some favorable guidance that matches this up and makes it more of a apples to apples comparison rather than an apples to oranges comparison. So enough, you know, just on the forgiveness stage, brings us to our third polling question. Sorry, I skipped a couple. PPP loan forgiveness would be impacted by a 50% pay cut for an employee. Annual salary is $125,000. That brings us to the forgiveness stage of things. So you've completed your 8 weeks of, so your loan was funded this week, 8 weeks run sometime into June. There's a lot of open questions still. I mean, fundamentally, we don't even know what that application is going to look like yet. We know that the forgiven debt is not taxable income, but there's been some question about whether the expenses then give rise to tax deductions. I sure would think they would, but there's a case law out there, old case law that says if you have money that you're not on the hook for, then it doesn't produce a taxable deduction. I had a question today on the state tax side. We certainly don't know that either. How are states going to conform to this? How are states going to, how are they going to view the forgiveness for state purposes? Don't know. We don't know what happens if you fail to meet the 75% test. You know, uncertain interpretations, the apples to oranges comparison I raised there with the quarter to 8 weeks. What happens if you don't use all of your loan? Does it just become a 2-year term note, or you somehow have to return it to the lender? And then what also, it seems likely that many people are going to go to the forgiveness stage and find out that they either borrowed too much or too little because there just wasn't good information at the time they applied, and what happens there. We think that it's whatever this process becomes, the application process, it's likely to be application for forgiveness. It's likely to be quite a bit longer and more laborious than it was to apply for the loan. You're going to have to provide a lot more documentation. Again, we keep hitting this, but the importance of planning on the front end to make this easier, and that you may find that there were initial errors. They weren't intentional errors, but either made by the bank or by the borrower. And hopefully it's as simple as just giving that money back, but we'll find out. It brings us to our fourth polling question. Forgiven debt on a PPP loan is taxable to the borrower, true or false? And I'll turn it to Tom, maybe. Tom, I left you a few minutes anyways.
I wanted to spend a little bit of time talking about what Eide Bailey is doing for our clients. We spent a substantial amount of time helping clients understand this program and prepare for and actually make application. And now we're shifting our focus to this next page that we've been talking about today, which is maximizing the forgiveness. And we've developed a modeling tool that will help us do that. And what we're doing for clients is we're projecting what the forgiveness part of the loan will look like based on the assumptions that the client gives us as what they plan to do during the 8 weeks, and kind of a baseline that shows the client, okay, if we do this for the next 8 weeks, how's this going to shake out? And then if that's not an acceptable outcome, we're going to work with the client, adjust assumptions, strategize as to ways to maximize that forgiveness. So we're up and running, ready to do that. Many of our clients have been funded, and we need to start that work now. Time is of the essence, because the further along you get in the 8-week period, the less likely you are going to be able to turn the ship. So you want that assistance, reach out to your Eide Bailey representative. And if you're not a client, you can go on our website and fill out a little information request, and it'll get it to us, and we'll respond to you and start the process.
Tom, and it brings us right exactly to 12:30, so perfect timing. Just as Tom mentioned, we do have, if you go to eidebailey.com, we have a portion of the website right now that's dedicated to the PPP loan. So it has links to our past webinars. It'll have a link to this webinar. We have some articles out there, some different things to consider. So I'd encourage you to go with any questions. And with that, I just thank everyone for attending. Again, I know we had lots of questions roll in, lots of questions via the chat and the Q&A box. We're just not able to get to them. We'll try to put them, collate them together, and if they're common questions, answer them. But otherwise, just reach out to your local Eide Bailey professional.